One.
I'm a finance student. Half my batch is trading options. Some of them are making money. At least that's what their Instagram story says. Most aren't talking about their losses. And honestly, I have been tempted to. But then I read a SEBI's own report. 93% of retail FNO traders lost money between FY22 and 24. Not 50%, not 70%, 93%. The total losses over 1.8 lakh crore rupees. So today I wanted to sit down with someone who's actually trained thousands of traders through NSE and ask him the one question nobody wants to answer honestly. Are derivatives even meant for people like us? So today, my name is Harshvardhan Singh Rathore. I'm student of Christ University, currently pursuing my MBA. Together with me, I have Taruni. And so thank you for doing this today, Tarun.
Namaskar. Welcome. Swagat hai, and thank you to both of you for hosting me on this platform. And as you mentioned, I've been training with a lot of financial intermediaries, on various topics, so from fundamental to technical to derivatives, and also now the compliance side of it. So we are seeing that in the last 6 months to 1 year, the training on the compliance side for financial intermediaries. So who's a financial intermediary? It could be an exchange, it could be a depository, it could be a broker, it could be a sub broker, has gone up. And hence all the financial intermediaries, because there is a force, there is a regulation, and also there is an intent from the regulator, which is SEBI, one of the most professional regulators in the world, is pushing for training across the vertical chain or vertical hierarchy of intermediaries. And that's how Harsh and Taruni, I consider myself fortunate enough to be doing these kind of trainings. So thank you for such a, I think this is the need of the hour. Derivatives, we need to understand whether it is even tradable by retail investors or not. So, thank you for hosting me, and thank you for designing these questions so that people can listen to us, students especially. And I will share my experiences as we go along these set of questions that you prepared.
Okay.
Yes.
Taruni. Okay.
So let me start with the first question. Sir, you know that SEBI has made quite a few changes in the F&O segment lately. So for viewers who might not track it closely, what are the key changes that they have introduced?
Okay, so the biggest change is on the weekly expiry side of it, where they have killed a lot of expiries which were weekly in nature, and they have been moved to monthly. Now, is this detrimental for the growth of the market? Absolutely not, because as we understand from Jonathan C. Hull's book, which gives us the basic definition. I think every student of finance, and if I am not mistaken, if I still recollect, I mean, if they've continued the practice, Jonathan C. Hull book was a very distinct book in the library. And I'm talking about the pre or the early YouTube days. It was a green color hardbound or paper cover book, which you could easily spot in any bookshop and in any library. So Jonathan C. Hull book started with the definition that derivatives is for risk management. And there are two sides to it. So one, you actually own the product like an airline company or a farmer, and then you hedge it. In all such examples that we have studied derivatives, we have seen two transactions happening. So one is you are a farmer, or you are an airline company, or you are a commodity owner, and then you are trying to hedge it. But that possibly that aspect possibly got subdued, uh, and that you know that portion was missing when traders young, a lot of them pretty young, and some of them while driving. So I've met a lot of auto drivers also, cab drivers also, were trading at signals. And this is not hedging, this is not management, this is pure lust, this is greed. So one is killing of the weekly expiries. The hedging comes from long dated options, which are also known as leaps, if you understand it, right? So there is a product called leap, which is long dated options. And so we are shifting to that era where SEBI really wants us to use this product for hedging. Second is obviously the margin has gone up. So as you go closer to the expiry, the margin amount picks up. You have to put in more money, and that is discouraging retailers to participate, which is very good, I would say. there's a minimum amount that you require. So close to a lakh rupees you would require to enter into these products. And if markets get volatile, or if you're closer to the expiry, that is where majority of the trade was focused. There is something known as zero hero strategy. So you become a hero overnight, and that's was the name of the strategy, and that was the intent of the strategy. It is because of a factor called gamma bust, which is very high on expiry days, especially around 230. But many people were losing money and becoming zero in this inside. So that is also they are trying to control. And obviously, it looks like we are headed to a phase or to a situation where, in Singapore, for example, they look at your net worth, they look at your financial standing, and only if you have a certain standing, or if you have a financial standing, then only you are allowed to trade in derivatives. Possibly we are heading to it. The derivatives should be used by institutional players. I always feel that, and I would elaborate on that. These are the major changes. So killing off the expiries, making it harder for people to participate, and putting in money. It is for people. So the ultimate realization has to be there. It is for people who have been there, done that, who have all sorts of financial products, who have access to insurance, who have access to real estate, who have access already invested in gold or silver via ETFs, who have mutual funds, who have stock bases, and then only you are investing in this. It's like a product on the top of the pyramid. So you have to climb the financial hierarchy. You have to go through this financial hierarchy. First, you have to access all these products and then use it. What was actually happening is it was just an inverted pyramid. So people at the bottom of the pyramid, uh, people at reception, hotel receptions, people who are drivers, people who are watchmen. In fact, in one of our sessions, there was also a security guard from one of the exchanges attending the session, which was happening somewhere. All of these been trying to access. So that's the background of it. That sets the question. And these are the three important factors that I spoke about. That's what the regulator has brought in. Yes. So we can move on to the next question.
Yes, sir. I was just unmuting myself.
Yes.
So, sir, the contract size went from 5 to 7 lakhs to 15 to 20 lakhs. So, a
Right.
college student or a salaried person with 2 lakh capital is essentially priced out now. So, is SEBI solving the problem of retail losses or just making derivatives an elite club?
I would not say, that SEBI is actually trying to solve a problem. The product had become a greed, and especially among students. So when you say that the contract size has increased from 5 lakhs to 15 lakhs, it is the notional value. So when you multiply it by the notional value, and notional value has a certain formula, you can check it out. It is essentially preventing people at the bottom of the pyramid from participating in such products, because the it's a it's a product which has the payoff is absolutely non-linear, right? So, and when the payoff is non-linear, that means you can make tremendous amount of money in a single day. The risk is also non-linear, and the non-linear risk is not something that the retailers can sustain or face. We have seen college money, pocket money, money meant for education, money meant for maybe wedding deployed into it, which is basically your liquidity money. If you talk about the financial goal, so student has a certain financial goal to attain. He's not come there to attain, nirvana through greed. No one has attained nirvana through greed. It is only time. Nirvana is attained through time. So you have to experiment with lot of strategies before you become successful. So what SEBI is doing, that this was becoming, though it is a structured product, structured in the sense that it is from the F&O market offered via the exchanges, but the market was behaving unregulated. And at that point in time, the regulators definitely have to step in. It is not about SEBI. Had they seen this kind of scenario anywhere in the world, any regulator of the world would have stepped into, because it was behaving, the behavior, the herd mentality, the herd behavior was getting unregulated. And when you have this, this, if say you made about 5,000, 10,000, 20,000 rupees in a day, it was distorting the culture of education also. So when the professor is training, what was happening is people in the library, sitting in the library, or people sitting in computer labs were not listening to professors. In fact, one of my students from Indore sent me a screenshot that the professor is busy training, but these guys in the computer lab are actually training. So it was distorting our education culture also. We come from, we have had Chanakya, who set up the very famous university. We also had this famous university, which was in Nalanda, which is the world's first university. A country which has given the concept of university, there the education was getting distorted, because what is the need to study if I can make 5,000, 10,000 a day? That is equivalent to monthly basis 2.5 lakhs monthly, if you can sustain that. So SEBI is it killing the product? No, the product still survives. Is it changing the access of the product? Definitely yes. So when there is too much of a crowd, there are safety concerns also, and there are concerns of stampede also. What we have seen in this with the product is that a stampede was happening, and a lot of people were getting killed because too many people were trying to bank upon a product which is too risky. These are weapons of mass destruction. So this is like a nuclear energy in terms of, in the words of Warren Buffett. So this is like a nuclear energy. If you know how to handle it, you can, be called India. And if you don't know how to handle it, then you would possibly be called Pakistan, right? A beggar country. So nuclear energy, is it bad? Absolutely not. But can every student be taught to handle nuclear energy? No, it would require some amount of patience, some amount of training, some amount of theoretical background before you are allowed to even enter a nuclear facility. And that is the act of, or that is the intent of the government slash the regulator, that only people who are suitable enough to be allowed to handle this nuclear energy. If handled well, it can light up your house. But if not handled well, then this is a nuclear energy. It will blast in your hand and it will blow off the entire community. So people were getting wiped off. People were developing, students I'm talking about especially, were developing suicidal tendencies. Uh, People have dropped out and we had to counsel them. You'll be surprised that there were people who were making, anywhere from 1 lakh rupees to 2 lakh rupees a month, experienced professionals. So it's not just about students. Professionals who were making 2 lakh rupees a month, they were rather willing to work under me for about 20,000 rupees a month. And what is the objective? What is the purpose? They want to learn options. From 2 lakh rupees, the whole family system was getting distorted. Why the family system was getting distorted, Harsh, is because the person is married, has 2 kids, wants to leave their job, come to our office, sit there, and join product or leverage a product which is absolutely risky, which can possibly destroy the family culture also. So very, very risky. So I don't think SEBI is restricting students' access. It is saying go back uh, to possibly where you are trained well, maybe NISM facility, learn about derivatives, work under someone for a couple of years before you handle it or not. It is a nuclear energy, and I say that with a lot of sincerity. And all the examples that I've mentioned, these are not made up examples; these are real examples. We have seen students under stress, family under stress, and the whole community under stress. It's a nuclear energy. So it's not restricting. It is saying go and learn it properly. But if you are trying to access it on your own and trying to escape uh, the education system, then the whole macroeconomic will go for a toss. So it is what distorting the macroeconomics of it. And you have the numbers, you have spelled out the numbers earlier. So I don't think it is distorting, it is restricting access. The access to nuclear facility requires some monitoring and some access, and that is what I think SEBI is doing. if you can take that analogy from me in that sense. Yeah.
Tarun, can you take the next question?
Sir, as we know that Bank Nifty weekly expiries happened around late 2024. So what kind of impact has that had on people's trading behavior?
It had a lot of impact, but let me clarify. This initiative, this step was taken by SEBI because someone was manipulating our bank, and we know the name of that firm. So there is a case order which has gone to SAT, and that particular HFT. In fact, I was listening to, I think, and if I'm not mistaken, Bill Ackman's interview recently, and he said recently, I mean, in the interview that I saw, he mentioned that there are only 4 market makers in the world. Who's a market maker? So let me just digress a little bit and come back to the topic because I'm building onto my topic. So there are 4 market makers. So when you buy and sell, who takes the counter position? Someone has to take it. What if the order does not go through? Then you'll be sitting for hours and the trade never closes. So the market making is a concept. When you punch a buy order, someone has to sell it to you if no one else is selling. If you want to sell an order, if you want your sell order to get executed, someone has to buy it. What if there is no buyer in the market? Then you will lose the whole confidence in the stock exchanges, because exchange is a B2B. It's not a B2B. It's a technology platform. It is an exchange platform where the buyers, it's a B2S, so buyers and sellers meet. But what if there are no buyers on that day? You lose confidence. What if there are no sellers? Then a parallel ecosystem will start. I have the shares in my demat. I'll go and sell it offline because I am facing difficulties selling online. So globally, there are only top 4 market makers, and Jane Street is one of those. And Jane Street in India, they were hiring our own people, our own students with very high salaries, 4 crores, 5 crores. The recent salaries of 5 crores, a fresher, absolutely a fresher, but the top brain. In certain cases, 2 crores also. And there's a whole case study which is done by Mayank Bansal, who's the head of hedge funds, a community based out of Dubai, based out of Middle East. He presented, and I think he also presented to SEBI. Just search for a guy called Mayank Bansal. He presented to SEBI that a particular HFT was, buying the underlying, which is the cash market. So they were buying maybe, HDFC Bank or some other bank, because if you only move 2 stocks, or if you just control the movement of 2 stocks in Bank Nifty, and I'm talking about 2024 and 2025, if you just to do that, you could control the movement of Bank Nifty. Now they were so precise, the control was so precise that they would decide, it's like a precision strike by Israel. You decide that you want to fire a missile in a certain building which has a certain window. You want to fire a missile through that. That was exact the precision that they were doing. So what they were doing is they were deciding that Nifty would expire plus or minus 10 points, or Bank Nifty would expire in 30-40 points. That was the precision. They were able to control the movement of the stock, and hence also the expiry of Bank Nifty. It was absolutely getting manipulated. So out of 4 expiries, 2 expiries were very volatile. The movement was akin to plus or minus 3 standard deviation. That should happen once in a year, maybe, but it was happening out of every 2 expiries. It was 4 expiries, every 2 expiry, very volatile expiry. A movement was akin to plus minus 3 standard deviation. The 2 expiries were absolutely non-volatile, absolutely dead. And they were controlling which expiries would be volatile, which expiries would not be volatile. The whole energy from selling options, or trying to make money in options, or trying to make money out of theta decay, the whole focus, the whole energy of the entire trading community, especially the prop desks, which have anywhere from 50 crores to 500 crores to deploy, was in estimating what Jane Street would do today. So everyone was focused on one just guy, and we were sort of leveraging tools like historical volatility. I have a very good tool. I am possibly the first person in India to have spoken extensively about a tool which is available free of cost on TradingView. I was training prop desk that today looks unusual, and we have had certain cases. We have recorded that also. The whole prop desk who were getting trained under me was using a concept called historical volatility, and we saw some footprints. This was becoming very, very evident that there is someone, everyone knew that someone is manipulating, but who was that was not known. And an investigation was run and realized that they were able to control by owning, or holding two banks. After which a change was introduced that the number of stocks which would be there in an index, the minimum number was increased. So earlier it was 12 or 13. I think now it is 14, if I'm not mistaken. And the top 2 or 3 would constitute not more than 45%. There is some regulation there. We can speak about it in some other class, which is very, very important. So see how the regulator is trying to protect you. It has to do a whole lot of change. First of all, it had to collect a lot of data from the exchanges, study the patterns, speak to a lot of experts, which is because you simply cannot go after one of the largest market makers slash an HFT firm. They seized about 45,000 crores, if I'm not mistaken, but 80,000 crores taken and total 1.8 lakh crores taken. This is FD money. This is retail money, which was also making a hole in the balance sheet of banks. We have already gone through a very bad phase of NPAs as far as the banks are concerned. And somehow the government and the banks have been able to recapitalize it. You have to follow Basel II norms or Basel III norms. You have to have a certain tier 1, tier 2, tier 3 capital structure in the bank. And the deposits were being stolen away. So this is like East India Company taking away the money from India. So this was colonization of India 2.0. One was between 1600 and 1800. The second was between 23 and 24. We lost $45 trillion during the colonialization period, and that is a number which comes from Shashi Tharoor, the Honorable MP, Member of Parliament, and also who was at United Nations. Right? We lost about 1.8 lakh crore. This number comes from the Honorable Finance Minister. So when they shifted Bank Nifty from a weekly to monthly, their expiries, the strategy went for a toss. There was a quote already, and listen to this very carefully. This is very important. And we are fortunate we're talking about it because we are leaving a timestamp of what we have spoken about. No one in India has possibly done this. So there's a court case already going in between Jane Street and a company called Millennium. Jane Street blamed Millennium, that Millennium guys from Jane Street switched to Millennium. I think that's the name of the company. And they stole all the logic, the algo logic, and they deployed it. And there was a court case going on. So and this was in the court of Delaware where I have been. So what I did is from the court of Delaware, I extracted the court judgment. And listen to this, what happened. The important points, the strategies were redirected. You know that it is blackened out. So you could not understand. Thankfully, our regulator, SEBI, uploaded their entire strategy and also uploaded the entire law. So now the whole world knows how Jane Street was manipulating the markets, right? And that is SEBI's. It is not my statement. This is what SEBI found out. And the court case is already, they're still going now. Jane Street is, the court has, this has gone to the appellate tribunal. And Jane Street recently said via media that we can't do this in that sense. So please allow what we are supposed to do. But SEBI came very hard on Jane Street, and they never redirected any portion of their strategy. Uploaded everything, and that exposed. So there they are absolutely in shock, I would say, with this kind of an approach. So we never killed Bank Nifty. Bank Nifty is for hedging. I had met a hedge fund in 2024. They were in the process of raising funds. I think they had already raised 100 crores. They were in the process of raising going till 300 crores. They were talking to a major AMC. He told me that day, and listen to it very carefully what he said. Now, these are something which never get captured in the mainstream media. He told me, Puratan, that, and this is very important. And, this is quote unquote. He said, an emerging market focuses on theta decay. That means you sell a call option or you sell a put option, sit for the whole day and make a lot of money. When I was visiting a major research firm in 2018, we were told the market is this is 2018, market is very dull. Nothing happens in the market. It's very boring. It was the golden period for short sellers who were selling and sitting on it. And the selling practice emerged in India after 2008. So selling a call and selling a put was not very prevalent. After 2008, this started picking up. People made a lot of money. 2018, this became even more popular. That is the first time, 2017-18, Share India, which is a listed entity, they've been working on algos from that point of time. And Algo Share India is one of the largest players in India because they started early. So this is a phase when, selling with logic, so automating it became started, picking up. And today, every broker wants to be like Share India because they have really grown big. I think they have a market cap of 4,500 crore or something like that. It's like a mid cap. I'm not sure whether it is classified as a mid cap company. I think only beyond 10,000 crores are classified as a mid cap company, but it's a sizable player. So anyone who was operating in 2018 by selling stocks and all, they were very happy. 2024, this is August 2024. I am told by the hedge fund that people are crazy here. In an emerging market, you can sell a stock, sell a call or a put option and make tons of money. But as you transition from emerging economy to an emerged economy, this is very important. You would have to focus on IV strategies. Now, I present you two evidences why Bank Nifty was killed or why the weekly expiries. Bank Nifty never got killed. Lot of indices on which there was a weekly expiry. So mid cap, Financial Nifty, Fin Nifty, Bank Nifty, they all got the period, they elongated the period, the expiries. And why is that? So listen to it carefully. Bank Nifty, we had maximum number of people who were doing that. So whole of Mumbai, whole of Ahmedabad, whole of Surat, whole of Delhi, they were focused on Bank Nifty because there are lesser number of stocks and it is a sectoral stock. So, the beta will be high. So the risk parameters will be high. And if you just manage 2 or 3 stocks, you'll be able to manage it. So we were told by a hedge fund that we'll have to shift from theta decay policies to IV policies. Traders who shifted from India to Dubai. So if you know this, there's a place called DFC where you can open a firm and it's like an SEZ. You can open a firm. In December of 2024, someone told me that in the group they lost 500 crores. And this is all trading the US market. The whole Indian community, which I think needs to be also, someone has to validate and verify this. The number that was given was astounding. 2,500 crore rupees lost of Indian traders who all shifted from India and started trading in the US market. And now you see very amazing pictures of Rolls Royce and this and that, and influencers that life is very cool in Dubai. But when you talk to top traders and genuine ones, not the fake ones, not the guy who wear the copies of the LVs and other such brands. Why did they lose money? And then we come back to a question. They lost money because the US market will allow you to sell options for 3 months, 6 months, and give you amazing amount of money. Because their options market is absolutely deep. So you can go 20 strikes away and sell. You can go 20 strikes OTM, 20 strikes OTM and sell, still find liquidity. Why? Because there is a market maker sitting on the other side. Here, if you try and do that, you'll not be able to sell that. Stock options, there is absolute liquidity in the US markets. If you move 10 strikes away, OTM, call or put, the order is stuck for 1 hour and sometimes a full day. You are making, I have seen profits of 2.5 lakh in a single day but the order never gets executed. And those transactions we had to close in losses. It's a game of liquidity. So US market allows. It will allow you to make money for 3 months, for 6 months, 9 months. But when the volatility comes, when the IV comes, it will wipe you off because the volatility is so much that the broker who's given you the facility of selling it, there is a margin call comes. You know that this volatility will not last for maybe 1 hour, 2 hours. It will settle down, but the margin calls are, uh, you know, you get the margin calls and you have to close the positions. 500 crore lost single person, 2,500 crore lost the entire community. This is the kind of volatility. Then I was reminded of what was told to me in August 24 that India is going through a regime change, which I train on. So when I train on derivatives, I talk about regime change. We are shifting from theta decay strategies to volatility based strategies. Why is that happening? Because not 1 year in a row, not just second 2 years, but 3 years, rather 4 years in a row, we remained at the top of options club. According to the World Federation Exchange, we were the top performing volume wise, not value wise, not dollar wise, but volume wise. We were the largest options trading in the world. When you do that much volume, and when unprofessional, I mean, not trained retailers and not trained prop desk, because these retailers go and join the prop desk. When these guys go to the prop desk and join them, someone from outside is seeing absolute volume in options. They came, they crushed us so much that we started losing confidence in our own systems. So SEBI had to strike. The whole strategy was exposed. Because the strategy was built on weekly options, they said, okay, the first thing we'll do is we'll change the strategy, we'll kill that strategy. And in order to kill that strategy, the easiest way or the easiest methodology was to increase, so shift to a different. Now you go and experiment, do all your statistical analysis, hire new guys, spend more, and then try and make money in India. The point is, you can only be a market participant. A lot of people argue that, how can you do this to Jane Street? This is not legal. This is not right. This is not wrong. I mean, you can become a market participant in a market if you try to become the market yourself, and they had become the market themselves. They had become the marketplace. Exchange is a marketplace. That facility is available only to the exchange because they do not have interest in making money. When you have interest in making money and you also become the marketplace, then it is a diluted interest. It is greed. So when it killed, a lot of people naturally suffered, but the pain was lesser than what the pain India could have seen. A lot of people who were just doing weekly options bank nifty for their entire life since 2008, 2018, they suffered. But if you look at the hindsight, this was required because anyways those guys were not making money. So when I speak to people, when I speak to intermediaries, we realize that till date, not enough money is being made. I'm talking about people at the top of the club, 100 crores, 500 crores. They're not happy because they have seen a golden era. They have made a lot of money. Now, I don't think anyone is really making money by option selling. Today, you make it. On 17th of April 2024, the volatility was so much that people lost anywhere from 4% to 10%. The objective is losing only 1%. I know of guys who lost 4 crores, 10 crores in a single day. The volatility expected, you lose only 1% as a professional trader. You are supposed to lose only 1%. They lost anywhere from 4% to 10%. In that order, they made money rest of the times, but it took full year to recover. So when you have such extreme volatilities, the break-even time exceeds, and sometimes the break-even time exceeds your lifetime. It is essential that we focus on options as long-dated products and not as weekly products. So most likely there'll be more weekly expiries going off the table. Yes, and I don't think anyone is speaking about it. So Harsh and Taruni,
Yes.
one needs to look at. We have to review the strategies. The whole firm, the whole building is just doing one strategy. So if you sit in the next building and just do the reverse of it and bring tons of capital, you'll be wiping off taking away the livelihood of everyone who's sitting in that building, because they are just doing, there is no risk management there. In the name of risk management, there is one office in the corner where these guys are only doing, I don't know what kind of, maybe doing a little bit of risk management. I think risk management has to be more, requires more software, advanced software in India.
So, sir, looking at it from a different point of view, so SEBI's own data shows that 97% of FPI profits and 96% of prop trader profits come from algorithmic trading. But retail doesn't have those tools. So is derivatives market fundamentally a game of where the house always wins and retail is just the liquidity, like what you said, because of the volume, volatility and the volume, Jane Street is making money, but they are also using high level algorithms and other tools. So what about the retail traders?
Yes, I think the days of retail trading, in the way we understand, is getting over. And let me give you a couple of data, which comes from Mayank Bansal's presentation. Point one is that, on any given day, these large HFTs and FIs, let's call them FIIs, right? Because they're registered as FI, have access to about 5 lakh crore of capital, all of them put together. Will never be able to sustain this kind of pressure. They not only have capital, but Harsh, they also have technology at their advantage. So they can go and buy racks, as you understand, right? So you could be sitting right next to the server of NSE or maybe BSE. BSE, I'm not aware, but NSE, so there the latency is almost equivalent to none. If you're operating from mobile phones, you have the worst price view. The prices come to you late. Some of the prices on the screen you don't even see. So if you are doing it from a handheld device, if you're doing it from maybe LAN device, cables, slightly faster, you would need a leased line from National Stock Exchange or BSE to have a professional speed, which most of the students, because you asked about students, they don't have. They are the worst sufferers. And since you're sitting in Lavasa, the data is traveling. So the price that I am seeing here in Koregaon Park, maybe you're not seeing it. Possibly you'll see it when you come to the city campus of price. And I'm putting it in a lighter manner, but I say that with a lot of sincerity. So someone who's sitting in Jammu and Kashmir, or someone versus someone who's sitting extremely down south, though there is a disaster recovery system based out of south also. I think it's in Chennai. So one is in Mumbai, one is in DR side. So if something happens to the exchange servers, it automatically switches during live trading hours. And that, as a nation, we have already tested. Switching from one server to the next server is something else. If you're sitting far from the server, prices you don't see, so you suffer as students the maximum. You would need a lease line. And if you're a professional trader, you need to sit right next to the server. Not everyone can hire it. There are some brokers who are making it reasonable for, not for retailers, but professional level. So you can hire those racks, but then you need technology on top of it. It's not possible for you. So what will retailers do? So retailers have gone to maybe two ways to access it. They have gone to all these algo trading platforms where you can code it. If your strategy has weight in it, has gravity in it, you'll be able to make money. The technology is being provided by sub brokers, or there are third-party platforms which provide APIs. So they are a connect between a broker and an API. So there are algo trading platforms. Manual trading, the days of manual trading are over. And to my understanding, if I refer to a magazine called Impulse or Pulse, I think Market Pulse or something, which is published by National Stock Exchange, the colo facility, so which is co-location facility, plus the direct market access, which is also algo, plus the algo trades. If you combine that number, which is in my head, and the graph that I remember, I think it is on page number 217 or 18 or something, that number is very close to 60% now, if not 90%. Maybe that is the latest data, but I'm talking about DM, direct markets, plus algo, plus a colo facility. It's a very high number. We will have to shift. Share India Securities saw an approach. I mean, saw an opportunity in that, and that's why they went ahead with algos very aggressively. But let me tell you, at this stage, I think sometimes because of volatility and sometimes because of the absence of volatility, everyone is finding it difficult. And when the intent is greed, when someone controls Strait of Hormuz to the extent of controlling the oil prices and hence controlling how the markets would open in different nations. If someone's sleep is linked to the market performance of many countries next day. So if you have a good sleep, the market opens globally, it opens good. If you have a bad sleep, the market goes for a toss. It's very difficult. So for manual traders, Harshvardhan, only IV strategies would help. Theta decay strategies for manual, for algo, it's very risky. Because if I tell you about my experience and exposure, I have seen algo strategies which punch orders like 100 orders in a minute. So you have a inverted butterfly, or what we call it as a short iron butterfly, being created every minute, and it's like hundreds of trades. So you have 400, 500 orders being punched. You have to download the log, and once you download the log, you have to push it to one of the AI tools to understand what kind of strategies are doing. It's like the way the meter changes. You've seen that at the gas station, how fast it runs, and you always felt bad about it because you wanted a petrol or a fuel of 4,000 rupees. It runs very fast. Likewise, the money in that algo system runs very fast. Your eyes can't hold those numbers. It's changing so fast. So without technology, Harsh and Taruni, I think it is very difficult to make money now, especially in the derivatives, because we have the highest number, one of the highest numbers. Our uh, volumes have definitely, linking it to the second question, our volumes have definitely taken a hit, but still the population is such a huge population. As we speak, the population is increasing. So I think it's gone maybe beyond 200 crores, and now a fresh census is being done. Possibly we are at 200 crores. So technology, obviously, if you have to beat, it's a game of the smartest. It's not a game of the foolish. And it is a game of the 1% smartest. So you are at 99 percentile. Only if you think that you are at 99 percentile or more, then you would enter into this unprepared. Otherwise, you need a lot of preparation. First preparation is theoretical concepts. So options basics, options advanced, regime change. Second is work under some broker, broker or sub-broker. Understand algo tools, either learn Python or have a co-founder who understands Python and then deploy. Because all these platforms like Backinzo, Algo Test, you would require some amount of Python intervention. Python is just at the bottom of the pyramid. Then you need C# or C++, because between Python and C#, there is again latency. So if you are running orders worth 100 crores, 200 crores, 4,000 crores, Python will not help you. So that is how I would like to talk about. I mean, like to summarize your question. These questions have a lot of layers, and that's why I'm speaking in depth. I thought we would finish this in 30 minutes. But people are not aware that I'm sharing my 3-4 years of experiences. C# you require at the top of the club. Only if you think you are in that 1% club, so 99 percentile, if your understanding of options. You need to take up lessons on basics of derivatives and advanced derivatives. We have both the courses which we offer, we train. And to some of the students, we train free of cost. You have to know Python. You have to go to Alco Test, Backinzo. There are a lot of platforms on which you can implement your strategy. Without that, you are absolutely, you don't have enough armors with you. Right.
So now shifting from macro policies to your individual experience as a trader and also as a teacher, yeah, moving on. So Taruni, would you like to take the next question?
Yes, sir. Sir, so from your experience of training people all along, so what is the most common mistake you see retail traders make when they enter into futures and options?
Correct. One is they think they can always win. So their probability for them is 100%. Right? So Taruni, they feel that they cannot be corrected. There is an unlearning process in this one, because the markets are always correct, and markets teach you every day. But that if you're not in that process, one is not in that process, then the ego gets brushed, and so does the bank account balance, right? And sometimes to the negative aspect. We have seen people borrow also. So one is, you'll have to first go to a probability class and understand the probability is against you. That is the biggest mistake. So I don't think before a derivatives class there should be a choice. For example, when I studied in US, to take up this course I had to do this. To take up this course I had to do a 101 course. So to take up a derivatives class, whether you understand calculus or not, you should do a 101 probability class, or and understand statistics very well. That is one mistake, and no one is training themselves, because there is always a probability of what I say. There are two ways. It could be right, it could go wrong. We have to use advanced tools like Monte Carlo simulation, which once you are here at the Institute Taruni, you'll be seeing we use Monte Carlo simulations, right? There are random bug theories that you have to understand. There are tests of stationarity and non-stationary. So whether it is stationary or non-stationary, that test you have to learn. So the whole technical analysis has gone from basic EMS, CMS to technical analysis. So having a very good understanding of patterns and technical skills, but on the statistics side of it, that's it. And they are not equipped at all, not at all equipped. So very, very important to know that. The other mistake is everyone wants just to jump in, and they don't want to, for example, learn it. So you have to first unlearn, work under someone. They always think they are right, and they don't listen. That's the biggest. So the listening skill is very, very important, and the listening skills come from reading skills. So first you have to read and then listen, read and listen. So I think the biggest mistake, Taruni, is the educational training. This is like surgery. Can you go to a surgery room or an OT, operation theater, without learning it? Absolutely not. People think that trading is all about seeing the screen and trading it, which is an old age concept, which was true in 2000 when I started my career back in 2000. But nowadays it's like a surgery. So you have to practice as an intern. So you also have MBBS as interns and postgraduate students as interns. They've spent about 2-3 years learning what they've learned. So you need textbook knowledge. You have to see that. You have to learn a little bit of coding. They think they are always right. That's the biggest mistake. And they think that money can be only made if you have large sums of money. If you have a good strategy, the market, Mumbai at least, from the point I understand, they are willing to give you 5 crores, 10 crores, 50 crores, maybe to start with 50 lakhs, 1 crore on your put on your strategy, but you don't get a second chance in that entire community, in that entire club. One person has a club. So test your strategies well. I think that's the biggest thing. And people are not doing backward testing, which is the biggest mistake, I would think. So, and overconfidence, nothing like it. And they are very happy to listen to influencers. For people who are like us, who are trying to create an awareness, it takes a lot of effort to reach out, and that's why this Q&A session we are doing. People don't come to us, but influencers, and if you are on the newsroom group, you would have seen promoters take years to build. If it is stock options, for example, so people take years to build a business. Many years. Fundamental analysts would define the business whether it is good or bad with 1 week of research. Technical analyst, 1 hour of research, he'll say this is investable. And investors, especially retail ones, who are in the process of always getting influenced, they take 1 minute to get influenced and get into the trend. The process has to be reversed. As an entrepreneur, I can have hundreds of ideas in a minute and get to execution part of it. The technical analyst should take weeks. The fundamental analyst should spend at least years to understand that business before he says whether the business is investable or not. And you should take at least 5-10 years. I mean, students and retail traders should take 5-10 years to believe before you believe someone. So this process has to be reversed, which I think people don't understand. So we are, because I speak from a certain platform, people come there to be influenced. They're looking for influencers, and that's the biggest fault. They want someone to influence. So that's how I would like to sum up this question, that do not get influenced and don't look for influencers. Even your teacher should not become your influencer. Because I stand on a podium and speak, people get influenced, which I think is the biggest issue or the biggest problem. Yes.
So you have already touched upon the influencers. So, but there is a culture now of YouTube thumbnails promising 1 lakh profit in a day, Telegram group selling short calls, and other influencers showing PNL screenshots. Many of them, we don't know if they are legit or not. So, how much damage this has done to genuine financial literacy?
Enough. In fact, to the extent that I have stopped training derivatives to people who do not come through uh, professional reference, in the sense that derivatives I am training only on a B2B basis. So if a financial intermediary approaches me, or if a college approaches me, then I am doing the training. If a broker or a sub broker approaches for training, then only I'm training it. To retailers, I've stopped because they come there, as I mentioned, to get influenced, not to learn. They are just looking for an influencer who can influence them. Influencers have done the greatest damage by wearing, uh, watches, costly watches, which is on borrowed money, by sitting in cars and showing off cars, which is a rented one, by sitting in choppers or standing outside choppers, which is possibly an edited image or a borrowed chopper. You can also, for 50,000 rupees, even for 4,000 rupees, if you are flying from Electronic City, you can take a chopper from Electronic City to Bangalore airport for a 4,000 per seat during peak hours. For peak hours, you'll have to book a seat. So it's very easy to click with a few lakh rupees these pictures. They have influence, and people are waiting to be influenced. In fact, every trader that I've come across, 99% of them, even matured, even professionals, they are looking for a Baba in this in this whole arena of wisdom. Practicality goes for a toss. Everyone is looking for an influencer, but the this is the last. These are the last days of influencers. Ask why. SEBI has sent a notice. So YouTube does not promote your influencer videos now. Try doing that, and ads will not get picked up. WhatsApp, they have already checked. Telegram now. Next is the days of Telegram influencers on Telegram is over. SEBI is sending notices directly to the platforms, and influencers have been asked to register as RAs, research analysts. There may be genuine people speaking, but majority of them have just opened laptops. They have no understanding of statistics. They have no understanding of probability. They have never looked at the Black-Scholes formula. They don't understand how corporate actions can impact your derivative prices. What if the dividend declares more than 5% of the market of the price? What if the dividend, the price that is declared, that is above a certain threshold, say 5%, 10%? What happens? How the adjustments are done in derivatives? People are not aware about compliances, and hence influencers, as we understand, were not making from money from the derivatives. SEBI has exposed them. In fact, I don't think any influencer has made any money. I don't think any trainer has made any money by trading in derivatives. In fact, we also have to lose money to keep training you, because if I don't lose money, no one will train me on derivatives. Correct? So I have to deploy my capital, and in certain cases, we see to the extent that how much maximum losses can you face. So you have to burn your capital to even be in the training business. But people have fudged their PNL, and this was exposed by a site called Money Life. Money Life is a magazine. Money Life is a site. Sucheta Dalal, if you have heard of it, the lady whose name gets associated with with the Times of India editor or news reporter who exposed Harshad Mehta. So Sucheta Dalal name appears, but I think there are other people also chasing that story. So it was not just the lady chasing that story. So they have a website, and where three prominent names who so someone exposed them, and that guy has gone off the screen, has become a Baba now. There are three prominent names mentioned there. You should just check for edited videos, PNL, Sucheta Dalal, Money Life, and just see what Google, what result comes out in Google. And the guy who exposes them, I think that story got picked up by Money Life. So this guy who exposes them on Twitter, he shows how the PNL of a certain broker can be edited using some video editing tools. So 10,000 rupees made becomes 1 lakh rupees. 30,000 rupees made becomes 3 lakhs. So there are video editing tools. I am not sure why government has not taken an action. I'm sure government is chasing them. Notices must have gone to them. If not through the regulator, because Regulators Act is to regulate, not to see who makes profit or losses. But I'm sure income notices from income tax would have gone, because IT department said that if you are posting first PNL, we will send you a notice. And I think they have got exposed. All these three guys have gone missing. It's a very famous article. So influencers, I think they're on a decline. Regulator has already taken enough steps. There are enough regulations. In a population of 150 crore plus, there will always be Babas in the group. It is not their fault, I would say. Ultimately, it is our fault, because you are looking for not a mentor who you can sit and discuss and come back and say this has gone wrong. One is looking for a guru or a Baba, and you believe them completely. To end your question, or to summarize your question, I would say that the problem is with the belief system, because we want to believe something. But influences are being tackled very, very strongly. And take my word on that, these influences will not last long, especially the popular ones.
So, sir, let me be honest about something. So, like, I'm sitting here as a finance student who's personally navigating this exact question: should I get into derivatives or not? So, my friends are trading, so like the FOMO is also there. But data says 93% lose, and whatever you are saying, it's also scaring me. So, if the odds are structurally this much stacked against me as a retail trader, why should I even learn derivatives at all? And why does PFA Institute teach it? So, what should we do?
It's a very question, and a direct question. Why does PFA Institute teach it? I like it the way you put it, Harsh. Well, derivatives. Can you join a risk management team without derivatives? So, can you be part of, say, Interglobe Aviation or Indigo, manage the risk? Does a chief purchasing officer require a risk management team to control the commodity cost? Yes. Does it come from derivatives? Yes. Does a chief financial officer of Interglobe Aviation or some bank, and for banks, currency derivatives, do they require it? Absolutely yes. So if you are killing derivatives as a knowledge base, that means you are killing your own capital markets, because the risk management as a function is gone. Then you will have to hire some Firangi, some Gora, and the only intent of the Firangis, no matter how Siddha they are, how honest they are, the only intent for a Firangi, their whole DNA is to ensure that India becomes a slave of these nations. They have been, these Firangis, whenever you hire a Firangi, even as an Indian company, their intent, they don't like the progress. Right? And there could be exceptions, but that's my overall reading, that these Firangis, so do you want to hand over the function, a very important function of risk management, to a Firangi company or a Firangi guy? Absolutely not. So you would need, in fact, we should be the best derivatives country on the planet, because when you walk out on the road, you are taking the maximum amount of risk, right? So derivatives we have to learn for risk management. It would require, it's like nuclear energy. So can you kill nuclear energy? No. It would require access control. And for that reason, only responsible people should be allowed to train on derivatives, because I don't know how derivatives, that's why there is a leash that has been put on these trainers. So derivatives is very, very important because every commodity company requires derivatives. Even now, electricity, it will become institutional. If you have to work in an institution, you will have to learn derivatives, and that's plain and simple. Can you make money out of it? Maybe you have some brilliant idea and execution capabilities. So it's not about just being too brainy. It's also having the required amount of technology. And Harsh and Taruni, let me tell you that okay, just technology is not enough. You need another layer on top of it, which is sufficient amount of capital. If that trading strategy, a beautiful trading strategy, could be done with 5,000 rupees, it will be exploited immediately. It will not survive the test of the day, it will not survive. So, for any suitable strategy to survive for a long period of time, even 6 months, it should require a combination of technology and capital. Otherwise, it will be exploited too soon by the retailers. So, derivatives is very, very important, but only under lab tested conditions by certified people. So, I think there should be stricter regulations on trainers as far as derivatives is concerned. Only if they have lost significant amount of money, then they should be allowed to train, and their PNL should be exposed, and trainers should not feel ashamed in saying that I have lost money, because only when you lose money, then you make money. So, and trainers, there should be a certain net worth of the trainer also. You cannot have any Tom, Dick, and Harry standing and trading or training, rather training. You should have a certain net worth of the trainer. Before you make it mandatory for the traders to have a certain net worth, the trainers should have a certain net worth, so that they can go and deploy their own capital, not borrowed capital, not someone else's capital under some fake promises. Make net worth as a mandatory, uh, as a mandatory requirement for training purposes. Then only they should be. Because if you don't have capital, how have you deployed those strategies? And if you've not deployed their strategies, that means you have not faced losses. And if you've not faced losses, that means you are not suitable for training. It is like, can a doctor conduct training without having enough experience? And all good doctors go to conferences and teach. All good surgeons go to medical colleges, government medical colleges, and teach, because that keeps them uh, uh, sort of updated in terms of the academic material. Academic material is also important. So having a training, so it is absolutely important for students, Harsh, but I think the onus is on the trainers more than on the trainers. But we should not kill that as a division, because you're killing a division and you're trying to become dependent. You'll borrow it from outside. For example, I really feel bad when we have the CEOs of aviation companies from outside. Do they really care about India? Do they really care about Indian travelers? And you have seen fiasco in case of an aviation company where the CEO had to resign and to be replaced. Right. So that's my thought for now. Training is very important so that you can work, but working is important for anyone. And my last sentence, possibly as the thought comes through, anyone who's trying to get into derivatives as a trader, you should prove that you have worked at least 2-3 years, because you are burning your family's money. And especially married people getting into derivatives, they should require some sort of experience license, having worked with any of the brokers for a couple of years before they want, because they have the onus of also taking care of their families and young children. Right?
Okay, sir. So now moving on, so we have learned. So if traders should trade. So now we are moving on to like why they should trade and how to do it and where to gain the knowledge from. So Taruni, can you take the next question?
Yes.
Yeah. Sir, so for someone who decides to learn derivatives the right way, so what would you suggest the minimum amount of capital, the time commitment, and the knowledge base they should have before placing the first trade?
Yes. The minimum amount of capital, more than that, I will stress more on the experience required. Get trained under any suitable person who's a credible face. Because what I've seen, trainers who are trading, they are trainers who are training. Uh, the strategies are good, But theoretical foundation, sometimes because they've not spent enough years in the library studying those books, it's not there. And a lot of your strategy now gets impacted because of the compliance factor. So while you can come up with a certain strategy, but it may not be suitable enough. It may not be legally compliant. For example, I recollect one conversation. Someone in northern part and not part of India was buying significant quantity of put options just before closing of the markets. Significant quantity, and those significant quantities was like 1 lakh OT and put options. He was severely penalized. So you have to know the compliance, part one. So work under someone, and in some derivative form, pick up the concepts. We also do the training part of it, and I'm fortunate enough to be training some senior members of India as far as derivatives training is concerned. And ISM is another this thing. They also have residential programs, and sooner or later, possibly, I would also have these training programs running at various institutes. We do it for few financial intermediaries. So learn it, and then also work under someone for 3-5 years, and work under someone as in a professional form. That is the only way to start the journey. Otherwise, one should not. Capital could start with as low as 2 lakhs, but more than capital, I think work experience of 3-4 years in a professional form as a derivative trader is required. And then you can start with maybe 10 lakh, 20 lakhs capital. But I would not focus on capital because understand that I'm speaking to students. So people have this confusion that capital is more important. So I am skipping that part and saying work in a risk management team where derivatives is deployed, and derivatives also as OTC. So even for shipping lines, there are OTC derivatives. That also is a perspective that I'll talk about. So for example, Tata has a company in Singapore. There are shipping lines across, so it is going to maybe through Strait of Hormuz, it is going through various shipping lines. There are derivative products based on that. And we had a very senior student / a member of PFA Institute who was head of derivatives there, and he was our student. So there are a lot of derivative products. It's just not about Nifty and Bank Nifty. So take experience before you come to this. Otherwise, don't come. The only thing. Yeah.
Yes.
Yes, sir.
So, sir, also we are seeing that SEBI's algo trading framework went fully live in April 2026. So, retail traders can now onboard into registered algo systems through their brokers. So, does this level the playing field, or it is like just adding another layer of complexity that already benefits the already sophisticated?
No, I don't think it benefits anyone. If you have the logic, you will be the one to be benefited. Please understand, the system is so smart. I have not seen a city like Mumbai. I've traveled to so many cities, maybe 30 plus, 40, 50 cities globally, including India. I don't think the system favors him. If it favors only the meritorious, so if you have merit in your logic, system will favor you. I mean, you will have people. It is for people who are selling their strategies. Now they are not allowed to sell their strategies without having the license part of it. So there are two ways. Say, for example, I have a logic and I was selling, for example, my strategy through small case or through algo trade. Now I would not be allowed to do so unless I am licensed. And license for any country is very, very important. This has to be regulated. Any Tom and Dick and Harry cannot come. There is a workaround also. If you don't have, lend your strategy to someone. Be compliant enough. So, for example, there are platforms that will take your strategy, code them, use their own RA licenses, and they will have a revenue sharing. But in your interest, in the longer run, one should have. If you have the quality, if you have the merit, why avoid skipping the license part of it? License is important because, as I said, it is like surgery. Surgery, you need two aspects. One is a practical aspect, one is academic aspect. So you have to study the books. All doctors study books. The feeling has gone that trading is only a screen-based reading feature. That is why what you see on the screen is your profit, is your risk. But in derivatives, it's like an iceberg. What you see on the screen is only 1/9 portion. What you don't see on the screen, because even till date, we don't have good platforms which plot theta, which plot gamma, which plot vega or vega, rho, and then there are other derivatives, derivative like speed. Even so delta has a second derivative which is gamma. Rho has or delta has another derivative which is known as speed. You don't see those, and they are not good platforms. So whether you talk about the top three, top 1, 2, 3, I would not name them. They are not plotting it. So people think what you see in the price is the only risk in terms of profit and the loss that you make. There are 9 more parts like an iceberg. So academic training for derivatives is very important. Just like a doctor simply cannot get up, a compounder or a nurse simply by watching the doctor do surgery cannot become a doctor. The same is the problem here. People who are sitting beside a trader thought they could become, but it's a very different world altogether. It's like a bond trading. You have to know the concept. You have to know what is duration, what is Maclaus duration, what is convexity. You can't simply start trading. So training is very, very important, and licensing requires is not a license, it's an academic license, it's a certification. So you have to clear the academic test. So SEBI has actually is as I said, in the name of a structured market, this was unstructured, getting very unstructured. So I think SEBI has done the right thing. We welcome it. In fact, it has killed my business. It has not killed my business directly. All I'm saying is because of all the stupidity going in the market, I have killed my own business. I am saying I will not train if you don't come from a B2B referral. I am not training you on the derivatives because you will go and burn your head. But that requires killing your own business. That requires responsibility in the market. Who name a trainer who will say that I will not train you? I have refused people because I don't want to burn your house. So SEBI is doing absolutely right thing. I think hats off to them.
So following up with that, so another side of the argument is that because SEBI's all these restrictions, they might actually push retail traders to go into unregulated spaces like crypto derivatives or offshore platforms. So what do you think? Is that a real risk?
Very, very good question. Very, very good question. Absolutely. And I'll give it a point wise. One is crypto is absolutely a sham. It's a shady market now. So see how my interpretation of crypto has changed. It was in the gray market sort of. So I never used to speak on public platforms. Then BlackRock and Vanguard. First, Vanguard comes with an ETF on crypto. That is the time I start speaking about it. It is followed by BlackRock. They come up with an ETF. When it is an ETF, that means it is regulated by SEC. Correct? So it's become a product which is regulated. Then our finance ministry also says that we are studying these digital currencies or cryptocurrencies. Right? So then it looks like that we are getting from a gray zone, or from a sort of a gray market area, black market area. We are going into structured kind of a crypto or this thing. But what we have seen in the recent, and I have made a video on that cryptos will be used to again manipulate countries and enforce their diktats. How? Listen to this. I made a video 2 days back, and then comes that US seizes cryptocurrency of Iran. So all the payment, because it cannot flow through from Iran, money cannot flow, or you cannot make payments to Iran, or you cannot receive payments. So it was flowing through cryptos. Because crypto, we don't even know and one of the most popular crypto, he's a guy with a hoodie. And that is absolutely crazy. That is absolutely, I think, stupid to have a founder coming in a hoodie and you don't know even the face of that guy. So these are all products which will be used by the West to manipulate countries. Today, if you promote cryptos, or if one promotes cryptos, and you don't have good relation with the US, they will simply ban cryptos and all your money is gone. So we have to do education on cryptos not being legitimate currencies. China does not like it. Russia does not like it. US, India does not like it. And we have seen the misuse of it. Today, because you are trading in dollar, so crypto becomes another dollar. So the only way to do this is in your own currency or shift to yuan. So we'll have to do. So the question is, if you ban people in a regulated, or if you make it strict, will people shift to yuan? it requires education there, that you are working against your own country, or possibly you are setting up yourself in a trap. Any day the relationship between US and India goes for a toss, your money is gone for a toss. Crypto will be blocked. You need to develop your own cryptos. Point number one. Whether servers are based here, will they go to other products like Dabba market is what they call it. The OTC market in India, unfortunately, has given a very crazy name called Dabba market. So, will they get to? I mean, you can't. If there is a regulation, say drive at 100, you can't stop people from driving at 300 kilometers per hour, and whereas they know the impact of it. But and that's how democracy works. So we can't do anything about it, Harsh. But let people drive at 300, and then the families will repent as to why the guy, where there was a restriction, speed restriction of 100 kilometers per hour, why is he driving? So you will have such people, but you will have to structure it. Otherwise, the whole country will go for a toss. It will be difficult to manage, and some Firangi will make an opportunity out of this one. They are just waiting for India to fall apart. So they will find loopholes and means and loops to control the country. So should the regulator, out of fear that if we make it too strict, people will shift to other products? I don't think it is. Everything is under surveillance today. So if you operate in the Dabba market, one may feel very safe. I think they are under surveillance. If you operate in the crypto market, do you think the Indian agencies are foolish enough? And you have just seen Dhurandhar Part 1 and 2, and you have just seen animated videos being made out of it as to how. Do you think that your financial statement is not available and your PNL is not available with the agencies globally if you are trading in cryptos? It is foolish to think so, because cryptos have become a risk globally. One example, check what happened with Iran. So stay away from these products, I would say.
Yes, sir. So to finish it up, sir, so last question is, so coming back to our main topic, which is derivatives for retail investors. So for 5 years, so from 5 years from now, will the Indian retail trader be a more empowered participant in derivatives, or will this market fully belong to algorithms and institutions? So where is your bet?
There will be some space for retail traders, and the question is how. And let me explain that. Very important question, and I'm really thankful to both of you for devising such beautiful questions, because I've never seen college participants coming up with such questions. It is like actually I am interviewing for maybe Z Business or CNBC or for ET Now or for Business Standard. These questions are very, very important. And I just wonder how both of you have got these questions. I am really amazed at the quality of the questions. And I hope it is not a chat GPT thing, which is not copied from this thing. Even if it is, these questions are very, very relevant, because uh, I think this will have a significant impact on the masses if they listen to what I'm saying very carefully, because the same thought I give to the exchanges that, and I made a chart generated using AI, so that nothing against the AI, that in the West, they are managing the risk, okay, through volatility and through options. So 3-4 pointers and then we'll end it. Okay. You have futures and you have options. So institutional players use options to manage directions. So if you want the Nifty to go up or Bank Nifty to go up, they'll use futures. If you want Nifty to go down, you'll use, or if you have a view, you can't control it, because anyone who controls, you've seen what has happened to Jane Street. So futures are for using for directions, and for managing the volatility. It goes up and falls all of a sudden. It goes down and recovers all of a sudden. Options are used. Retailers are using options for just the opposite way. Retailers are using options for direction and rarely using futures. You need to learn a composition of both the use of futures and options, F and O. Options for managing the volatility. Till 12:30, the markets went up and sudden fall in the market. Till 12:30, the markets went down and a sudden recovery in the markets. That is, options have to be used. Futures is for direction. Look at what FII is doing. There's a site called stockage.com. Go to the options, the open interest side of it, and see how they manage. point number one. So you have to learn both and you have to use that. As a strategy, I think covered call options, and I have requested one broker that if you have anything on covered call options, so do read about covered call options. As you build up your portfolio, as India builds up the portfolio, covered call options, I think will make sense. So you have the underlying portfolio, you hold the stock, and then you are selling OTM call options. So I think there will still be space. There will always be space for smart guys, because these smart guys will work under some hedge fund, get enough years of experience before they launch their own hedge funds. So what is the opportunity for retailers? To work under some hedge fund, some derivative company, some risk management company, some broking firm, leverage this thing, and eventually think of launching your own hedge fund. So this is just the start of a hedge fund or an AIF category. This is just the tip of the iceberg. We have not seen enough opportunities, but not by burning your capital. I was told early in my early days of my career that if you have to learn business, you should do at the risk of someone else's capital. है ना, आपको अगर बिजनेस सीखना है, धंधा सीखना है, तो आप किसी और के कैपिटल पे सीखिए. Exactly the same thought I'm saying. If you have to learn derivatives, do at the cost of someone else's capital. Join as an intern, work there. So there is always going to be scope there, and tremendous amount of scope, but only for enabled people, not for people with different abilities. समझे आप? And then you would see the exposure. India's structure of financial products, because India is an importer of energy. So the focus will be, government's focus is on the energy side of it. So real opportunities for students as job options will emerge on the electricity futures, coal futures. Have you seen a coal exchange being launched? MCX has also done that. Do you think these are disconnected stories? Have you seen electricity futures being launched and attaining a lot of volume? Have you seen an IEX, Indian Energy Exchange? These are not disconnected stories. So the part, you have to know where the market is growing. The market is growing, the commodity, the derivative market is growing on the commodity side and not on the agro commodity side of it, on the energy derivatives. So you have to find internship opportunities. You'll be surprised, Harsh and Taruni, that I was invited online to conduct a derivative session, and the reference had gone from NISM. And which school was this? This is NTPC MBA school. So NTPC also has an MBA school, and they train a lot on the energy derivatives. Some of them will be absorbed within the company, and some of them will, obviously 100%. There is no 100% internal recruitment or internal placements. Why would NTPC have an MBA school? Why would they teach energy derivatives, and why would they hire someone? The focus is shifting from financial derivatives to energy derivatives, that retailers don't realize, that students don't realize, that no one has an idea. And I have spoken extensively about it. Focus there. That is where the institutional part is. And a talent is always welcome. We are very happy to talk to them. If you have any strategy, if you think you have the back tested data, come and do forward testing with us. If you need capital, possibly I can connect you to, and if you are fortunate enough, you'll get capital also. We don't promise anything, but we are very happy to expose you to the world that you think of, but you should have the talent, technology, knowledge, and capital. So capital, maybe it is available in Mumbai. So you would need access to technology, and you need solid foundational background, and not the books that you've been reading. Maybe PhD level books.
So thank you, sir. I think a lot of people need to hear that, including me as well.
Thank you so much, sir. We learned a lot about, I'm sure both of us didn't know this much about FNOs and how derivatives work.
Yes.
So thank you for giving us such an insightful session.
Thank
Yes,
you.
sir.
Thank you, Taruni, for organizing this.
My pleasure, sir.
And
Thank
also,
you all.
sir,
Yes.
I would like to add for the viewers, if you found this useful, share it with someone who's thinking about getting into FNO. And if you want to learn more about PFA Institute and what it does, we'll drop the links below. See you in the next one.
Thank you, and thank you to both of you. And I will
Thank
end
you,
this
sir.
with a Indian style namaste, which I think is required. So thank you to you. And I think I really appreciate the time that you have spent on a Sunday morning. And I would always remain grateful for this effort and time of yours. People are not taking this effort. So I think extra credit to you to both of you for these efforts. All right, thank you and take care and have a good day.